Thanks, Chrissy, and thanks everyone for making the time this afternoon. Yeah, I think today and my talk's really a bit of a change of pace. You've seen a lot of companies present, and what I'm going to talk about today is just how we go about assessing and analysing and coming up to a view on how we want to structure a portfolio. So I'll run through it and give you a bit of detail. So basically, I'm the manager of the Argonaut Natural Resources Fund. We've been going since January 2020. Since that time, the fund is up 188%. As you can see, 22 and 23 were good years. 24, the way I described is you go through periods where you're making money and you go through periods where you're trying not to lose money, and financial year 24 has been a bit like that. We're about flat for the year, which I think is pretty good relative to our peers. But we're high conviction, so typically we have between 10 and 25 stocks in the portfolio, and we're looking for companies that will outperform. We've got a four-stage process. So step one is, what are the key resilient themes going to impact on the resource market? We're focused on resources, and we see there's two key themes. The first one is energy transition, essentially future-facing metals and markets, and then increased geopolitical risk, which I think we're all seeing the ramifications of that globally at the moment. From there, we then say, well, if they're the key themes, what commodities are best placed to capitalise on those key themes? And then from there, what are the companies that are producing or looking to produce those commodities? And we're looking for value and we're looking for quality. And I think really what we've seen in the last 6 months, if you've diverted away from quality and value, that's where you've got particularly hurt. And then on top of that, it's all very well to find these opportunities, but you need to build a portfolio and you need to manage risk. And that's something we really pride ourselves on. I think in something like 80% of the months since inception, when the market's fallen, we've outperformed the index. So I'll touch on energy transition first. Again, if you look back to the last 3 or 4 years, energy transitions, the thematic has been a whole new wave of demand coming in for a relatively small group of commodities, copper, nickel, lithium, rare earths, forcing up the price, driving new supply into the market, but creating some really good, some returns and equities that have performed very well. I think in the last 6 to 9 months, that story has changed. And I think what we're seeing is China really exerted its power over the industry. If you look at a lithium-ion battery, there's 3 key components. There's lithium, there's nickel, and there's graphite. So let's look at those. If you look at lithium, the price has fallen by something like 80% over the last 12 months. And that's been driven by production really coming out of nowhere. It wasn't really predicted by most of the market commentators, but what you saw is China increase its production of lepidolite production and also production coming out of Africa, which was largely funded by China. In the nickel market, it's been more of a longer-term program where Indonesia had the raw material, China had the expertise. By partnering together, they've dramatically increased the nickel supply of the tier 1 nickel for battery feedstock. So again, the nickel price is down 50% or so over the last 12 months. And then graphite, I think the surprise there is everyone knew that synthetic graphite is a reasonable portion of the market, but production really ramped up, and that put pressure on the emerging projects, and graphite prices are also down sort of 40 or 50%. So the implications are it's been a difficult 6 to 12 months for energy transition, all those future-facing metals. What that's meant for lithium-ion battery prices, though, is they've fallen, and China, being a real driver of that industry, have been able to produce cheaper vehicles and continue to grow their EV market. The second thematic is geopolitical risk, and that ties into the future-facing metals as well, because a lot of the locations where those future-facing metals are in locations where there is some risk. A good example of that is copper, where roughly 40% or more of global copper supply comes from South America, and South America has typically had supply disruptions over time. There was a major disruption this year in Panama, where a major copper mine was put on care and maintenance. So I think that's an ongoing thematic. I think the other thing is just a supply chain reconfiguration. So notwithstanding these commodities are spread around the world, I think what you're seeing is companies or countries are deciding who they want to trade with, who they want to buy from, who they want to sell to. And so you're seeing almost a duplication of supply chains so that there's security of supply. I think that's an ongoing feature. For example, in Australia, you're seeing the development of some lithium processing facilities, a lot of incentives in the US and the EU to move the exposure away from China in particular. I think that's an ongoing theme. And I think the final point I make on this slide is just defence spending globally is going to expand pretty rapidly. And a lot of the commodities that are required in that are things like copper, nickel and steel, and that will also give a good tailwind to commodity demand going forward. This slide kind of puts all that together. So what we're looking at here is the slide on the left, the three top producers of these groups of commodities. And what you can see is copper. Copper is a very big market, about 25 million tonnes per annum, about 10 times the size of nickel. So it's actually been, it's pretty diverse as far as the producers. And while China has a strong position in processing, it's 50% or slightly under. But what you're seeing is nickel, as we talked about. It's showing Indonesia there as the dominant supplier, both on the production side and the processing side, but that's really in partnership with China. Cobalt, dominated by the Democratic Republic of Congo, which is really a difficult place to invest, and then the processing is done in China, so dynamics there aren't great. Lithium, you see a lot of production come out of Australia. About 50% of the global market now is coming from hard rock spodumene in Australia, but on the processing side, China's still a pretty dominant player. Graphite and rare earths, as an investor, you've got to be careful where you have Chinese domination of both the production and the processing. And we've seen that with prices over the last year where those prices have fallen by 50% or more. So it just shows you've got to be careful in the commodities that you're targeting. So I'll just touch on a couple of commodities now and just give you some thoughts. So the first one is lithium. You can see the price has gone from a peak of $6,000. This is spodumene price, which is a hard rock lithium produced in Australia. So the price has gone from roughly $6,000 a tonne 12 months or so ago to a bottom of about $1,000 a tonne, and it's just edging its way up. And as I mentioned before, it's really driven by the fact that you just had a whole new wave of supply coming on, which wasn't really expected. It wasn't really in the forecasts of most of the analysts. So you saw a lot of production coming out of China through lepidolite production, and you saw a lot of production coming out of Africa, funded by the Chinese. So supply pushed ahead of demand, and the price fell. Lithium is still a relatively small market, so it's reasonably easy to get imbalances in demand and supply, and that's why you saw the big spike up, and that's why you saw the big collapse. The question is, how is this industry going to look going forward? So I think the Pilbara result is the Pilbara result for the half year to December, I think gives you a good snapshot of kind of how the industry might look in the medium term when it settles down. If you looked at the financial year 23 results, the EBITDA margin in that year was about 85 to 90%. So extraordinarily high, and that's when the prices were very high. In the last half yearly result, the EBITDA margins are about 55%, based on an average price of $1,645 per tonne. But that's for a 5.3% concentrate. The standard is 6%. So the equivalent of that is 1,800. So to me, the group's got a market capitalisation of about 12 billion. On those kind of half-year numbers, if you annualise them, it's difficult to come up with a value that kind of justifies that market cap. So I think the market's saying, we think that the prices are near their bottom. We think there's some upside, maybe a long-term median price is around $1,500 to $2,000 per tonne. So I think that gives you some optimism. Pilbara is also looking to increase its production. In that half year, it produced 320,000 tonnes, which is about 650,000 tonnes for a full year, and it's ramping up over the next few years to 1 million tonnes. But having said that, the spodumene price is currently around 100 to 1200. So some positives and some negatives there. Our preferred exposure in lithium, we're looking for the more advanced tier 1 scale development assets. The one we really like is Patriot Battery Metals, has a global scale project in James Bay in Quebec. Its market cap is about 1.2 billion and a high grade deposit, about 110 million tonnes at about 1.4%, but that's likely to grow to 150 million tonnes or more. And I think in all these companies and in investing, you're always looking for high quality management. And Ken Brinston, who was the managing director of Pilbara, he retired from Pilbara about 12 months ago. He's come on board at Patriot, moving to Canada to run this business. So, we think that's pretty exciting. It's our favourite on the lithium side. If you look at uranium, is uranium the next big thing? Look, I think uranium and nuclear power is undoubtedly going to grow market share. And what we're seeing at the moment, due to a lack of investment in both raw material and also processing technology, is you're seeing demand heavily outstripping supply, and really it's been a drawdown in inventories that has kept the market operating. The price of uranium has doubled in the last 12 months. And if you look at supply and demand going forward, you'd suggest that there's further upside there. There's really one company that I think is a standout in the sector. It's an emerging, or it's a developer pushing forward to production, and that's NextGen Energy, operating in the Athabasca Basin in Canada. It's received its provincial approvals already, which the approval process, as you'd imagine, in uranium is difficult and time consuming. So they've got the key approval, which is provincial. The federal approval should come through this year. They've got a big resource, very high grade, a multiple of what most companies in the sector have. Its market cap is already $6 billion Canadian, so it's recognised as a major player. It's going to be producing more than 20 million, potentially 30 million pounds of uranium per year. So that's about 25% of the global market today, and I think something like 50% of Western demand. So it's going to have a major impact, and its costs are going to be very low, about $20 a pound. At $100 a pound, it'd be making earnings before interest, tax, depreciation, amortisation of about 3.4 billion. So that shows you there's upside as they go through that process of building the facility and starting to produce. High quality asset again, it's one we really like, and I think really stand out in the sector. Copper, copper's a consensus buy. If you're in future-facing metals, most of them have fallen over the last year, as we've talked about. Copper has been very resilient. Demand is still very strong. The outlook is very positive. Our favourite is Metals Acquisition Corp, which owns the Cobar mine, or the CSA mine in Cobar. Very high grade, very good management team. We think it will emerge as one of the go-to copper stocks in the Australian market. And I've just thrown in a slide on gold, which is a bit unusual, but I think it comes back to that geopolitical risk factor. What we're looking for there is gold prices should continue to move higher as interest rates fall. There's three key drivers of gold. You've got China, India demand, particularly jewellery and retail demand, which has been steady. Central bank buying, particularly Russia, China, Uzbekistan, Turkey, etc., have really driven the price over the last 12 months. What's been lacking is the general investment market through exchange-traded options, exchange-traded funds kicking in. We think that we'll see improving demand from that area. So we look for long mine life, production growth, low OPEX, low CAPEX, tier 1 locations where possible. Our favoured Capricorn and Genesis. And just getting towards the end, just a developer checklist. So it's one thing to look at producers that are generating cash. You can put a multiple on them. You can look at them like a normal financial asset. When they're a developer, it's a bit more difficult. So typically we have a checklist where we're looking for an established mining province, significant scale, a mainstream commodity. You want to be in a commodity that people know and understand, high grade, capable management, obviously critical, external validation. So if you've got a joint venture or a partnership with an industry major, you've got an offtake agreement and that can all help. Transparent market, so easy to understand. Low costs, net cash is always good. Key customers outside China and strong ESG credentials. I'll leave it there. But thanks, Chrissy.